Oh, welcome. Welcome to December 4th. It's December 4th already, and it's the 2026 market update. Today, we're going to be talking about stimulus and productivity and gains that should be in the near term or will outweigh the near term obstacles. It's hard to believe it's already December 4th and 2025 is coming to an end, but it is. The year goes by quicker every year. Does that make sense? Not sure, but I look forward to the talk. Today we have Himalaya Jain, Sunny Singh, and Sarah Jones that are going to be talking to us about the markets. So kind of our last market update for 2025, and then we'll start with a few new ones in 2026. But I'm going to pass it over to them, and let's hear what they've got to say, because there's lots of things happening, and it seems like every day is just a little bit different. So you guys, if you can tell us where the market's going, what we should buy, and never go down, then we love you all. So we'll send it over to you guys. Give us, give us, give us what you guys think is the next best thing.
Well, thanks, Gord, for that great introduction. And I agree with you 100%. I can't believe we're almost at the end of 2025. Like, my gosh, where did the year go? I am delighted to be sitting with my esteemed colleagues. Himalaya, as I'll probably look over to my right, is where he's sitting. And Sunny's sitting on my left. So chances are I'll look over, just so you guys know where I'm looking. As I said, I'm delighted to be sitting here with these guys. Not only are they charming, as most of you clients know, but they're also extremely brilliant as well. So I encourage you, anybody who's watching at home, if you have any questions about what's going on in the markets, what's happened in 2025, or if you want to know anything specific, like Gord said, any of the surefire winners that are going to happen in 2026, then please send us a note and we will try to get to your questions. So I thought a good way to get into our conversation tonight would be having a walk through what happened in 2025. So let's start off with you, Sunny. If you were to sort of summarize what's happened in the markets in 2025, give me one major salient piece that comes to your mind.
I think everyone would probably say the same thing. I have two, to be honest, but the one that really stands out is of course Liberation Day and the tariff announcement that we got back in April. We saw the administration, they announced tariffs ranging from 10% to 40+%, I believe, on most of their trading partners. That single policy shift really forced investors to rethink everything, like from supply chains to corporate profits, and it really set the tone for the protectionist environment that we navigate for the rest of the year. Now, the tariff announcement really did fundamentally reset the global playing field, I think, and I think that's going to continue to be something we have to work through 2026. Less of I think investors have started to digest it a little bit and accept that volatility will be there, but it definitely has not gone away. But there was a number two that I think was important. I know you asked for just one, but I wanted to just touch on it to remind everybody how dramatic the move was after this occurred. And that was the China DeepSeek AI model incident or situation that happened in January that gave investors quite a scare about the amount of US tech dominance that does exist. And essentially DeepSeek was an AI model that was apparently it could have been built and trained on at a fraction of the cost of what we were doing here in the United States. So the market, as they typically do, they shot first, asked questions later, and those tech stocks plunged, including NVIDIA, which I think had a very, very significant decline. But then after asking the right questions, there was a deeper understanding of the models and the actual cost of developing these models. And then we start to realize and start to get more optimistic on overall the AI market in general. So we saw a big rebound in tech stocks. So I think those two situations were the most meaningful to the markets this year.
Well, that makes a lot of sense, what you're describing, Sunny, because it felt like 2025 was a bit of a roller coaster. And I don't even feel like we're off that roller coaster yet. So some of the volatility that was that we went through during 2025, Himalaya, why don't you describe other contributing factors to the roller coaster feel of the year?
Yeah. think back to January. We started the year thinking that there would be the policies of the new U.S. administration that would be very friendly to the market. Think of things like tax cuts, deregulation. So the market was really primed for some gains, and there was a lot of optimism starting out in January. That quickly went from optimism to pessimism as tariffs started getting announced. And, I think the volatility came from, the initial shock of those tariff announcements, and then the reversals. We saw, after Liberation Day, just a few days later, there was a pause, a 90-day pause. And then remember also that there was lots of other exceptions. There was carve-outs for certain countries, carve-outs for certain products. And as the year progressed, I think what most investors, including us, we started to become numb to the daily pronouncements coming out of the U.S. And the volatility that had spiked both in February, as Sunny was talking about, and also in April, that volatility started to decline through the back half of the year. And that's really what has led to the market not just recovering from those April depths, but also now far exceeding that. So we've had lots of shocks, but the market has really overcome that because some of those reversals, but also what fundamentally matters to the market, it's earnings, and the earnings story is very much intact.
And Himalaya, that earnings story, is that across the board, all industries? Is it just commodities? Is it just AI stocks?
Yeah, great question. So, and it's, you're right. It's not homogeneous. That earnings story is concentrated in several sectors. So yes, in technology, they've been experiencing faster than average profit growth. But you're right, in commodities, specifically in mining. We know with gold prices above 4,000, mining companies have been showing spectacular earnings growth. But other base metal miners, copper, other metals, even when we think about financials, banks, insurance companies, they've been showing very strong earnings growth. The one area, or a couple areas that have been a little weaker, tend to be more on the consumer side. The consumer is strained. But again, when we back up and we look at earnings growth, that story, we tend to look at it at the index level. And at the index level, that earnings story is very strong. It's close to double-digit growth this year versus 2024. And the forecast for next year is very strong too.
Okay, you mentioned index, and I get this question a lot. So, Sunny, can you describe how the index, let's talk S&P 500, has changed over the past couple of years? And I'm sure you know where I'm going with this question. Like there's such a concentration.
Yeah, I mean, it's been more than the last couple of years, definitely. There was a big concentration in the Mag 7, as everyone knows about, and it makes up a very large percentage of the S&P 500 now. So when you are investing in that index, you are essentially, investing in a very tech-heavy type of index. And there was a really interesting chart I brought up on a screen when I was presenting a decade ago, and it looked at average valuations of the S&P 500 for the decades before, but where many had projected it to go in the future. And what matters here is the composition of that index. Meaning, if you now have a higher weight in these tech-heavy, high valuation names, naturally the S&P 500 will have a higher valuation just because of those higher valuation names. But what's very important, and something Himalaya loves to stress on because it's very important, the 493 stocks in the index that are not the Mag 7, they're trading more in line or slightly above longer term averages. So we're not nearly as stretched on those metrics. So in 2026, if you believe that the breadth of the market is going to expand, meaning more stocks are going to participate in the rally, you should see these other stocks do well, and the S&P 500 should also follow suit. The caveat being you have a big pullback in tech, and that offsets some of that gain. But I think overall, if we do get the breadth that we're expecting, that should be a net positive for the S&P 500.
Thank you for explaining that to me. I guess it's been a couple decades, he said, so years do slip by as you get older. So.
I'm getting there.
Okay, I had another question. Really, I'm looking for an explanation, I guess, Sunny. Mm-hmm. We've talked a lot over the years, probably decades, about the globalization. So it seems like the economies got more and more intertwined around the world. But lately, I've been hearing and reading more about deglobalization. Can you explain that to me and to our audience, and what sort of market implications that might have?
Definitely, that's definitely been a change over the last year or so relative to the last couple of decades, where the world was definitely going towards a greater globalization, and it did achieve that. Personally, I thought it would go further, but obviously, change in political regimes can change those things on a dime, and that's what's happening right now. But specifically, tariffs, obviously, deglobalization, there was very specific and severe impacts. I mean, the percentage of world imports that were affected by tariffs this year were miles above what we experienced over the last couple of decades. But the pain wasn't evenly spread. It was concentrated in sectors that rely on cross-border commerce, of course. One that I've done a lot of reading about just because it's personal interest is the solar industry. It faced a monumental decline in exports and massive project cancellations due to the tariffs that reached as high as, I think, 50% on some of the very key components. So exports of solar panels from major suppliers like India plummeted over 75%, and that's just in the first 5 months of these tariffs being implemented. So this made, and this is where the question is, you've been hearing from those in the U.S. that tariffs are inflationary, but this made solar installations significantly more expensive for U.S. homeowners and businesses, and this led to project delays and really a cooling of the green energy boom that had been building for the last several years. Elsewhere, here in Southern Ontario, we know pretty well, metals, auto parts, things like that, iron, steel, aluminum, those were obviously hit hard. And clearly with a North American auto industry that was built to benefit from cross-border tariff-free business, they were impacted significantly. And then you have, textiles and apparel. That's clearly one sector that had been hit pretty hard. Himalaya touched on the consumer. But also it's the retailers that are offering these products to consumers. They've been hit with higher tariffs that have caused their products obviously to become more expensive and their margins to shrink because they're unable to pass on the full increase of the tariffs to their clients, to their customers. So, for the market, this meant companies with purely domestic supply chains became the new safety trade, and the multinationals definitely faced a bit of a margin compression. So it wasn't a broad-based impact on all sectors. It was definitely those that are more multinational commerce-driven.
Well, I like to shop, so that explains why my Visa bill's where it's at. Sorry, Himalaya, did I cut you off?
No, not at all. I'll just add to what Sunny said. There is a rewiring going on in global trade, which was initiated by the tariff announcements, and that rewiring of global trade. This is a multi-year process, so we don't know what the end goal is. But Sarah, to your point, the world had been moving towards a trend towards globalization. It's not that globalization is over. I would think of it more as a rewiring of where trade is going. So in that disruption, that rewiring process, it is going to be a little confusing in the short term as new trade deals get struck and new partnerships develop. But it seems, kind of 6 months into this new world of U.S. tariffs, it seems, again, from the data that we're seeing, that all is not lost, meaning companies and countries are doing that rewiring process in real time. and finding new markets.
Well, hopefully that means that prices are going to come down one of these days. Okay, another subject that stands out in my mind for 2025 is the various geopolitical situations that we saw over the course of the year. Himalaya, is there any of many very volatile situations, ones that stand out in your mind that particularly affected the markets?
Yeah, in any particular year, there are geopolitical issues that dominate and flare up. The two that have been preoccupying everyone's attention, of course, in the Middle East and in Ukraine. This year, those two again dominated. We seem to have that ceasefire in the Middle East. We're several weeks into it. It seems to be holding. The effect that that's had in terms of market is in oil prices. And I think we've talked about this in the past. If you want to see where the market thinks some of these geopolitical issues are going, look at things like oil. So if it's a Middle East issue, oil gives you an idea as to is the situation maybe getting worse or is it getting better? And what we've seen is oil prices gravitate lower, and as some of those tensions have come down, certainly not resolved, but the temperature has been lowered. I think that's, and the other issue with Ukraine is anybody's guess as to how long it goes. But it is fairly contained as far as North America goes. We're not as affected day to day in terms of the economy or trade. Europe is far more susceptible to issues such as energy prices or potential for that conflict going back and forth.
Okay, well, I think that although we'd love to see a simple, manageable solution to any of those situations, of course we can't. But what the effects of the different situations and how they're being managed obviously affect our markets. Having gone through the top situations for 2025, delving into those a little bit, this leads us to a good opportunity to step into the future, if you will, and look into 2026. I'll be here before we know it. Sunny, why don't we start off with you, and maybe you could give us what we are looking at as far as a big picture for 2026. For the last couple of years, we've been hearing talk about recession. Is that something that you think will unfold in 2026?
No, I think what's really changed over the last little bit is the last couple of years you've heard this term soft landing quite frequently, and it actually seems like that's holding up, or what might actually happen here. U.S. GDP growth is holding up well, and actually this morning, Himalaya and I were reading an article in the Globe, and these numbers actually came out last week, but they did a very significant revision of GDP numbers in Canada over the last couple of years, not a couple of quarters, but a couple of years. And what we've realized is, there's been a lot of talk about the productivity decline here in Canada over the last year plus, or more than that. But the numbers actually show that things aren't as bad as many had expected them to be. They're not great, but productivity, instead of declining, is relatively holding steady, and hopefully that does improve going forward. But it does support the whole argument of a soft landing. Also, I think what's really important, we'll talk about this a little bit later, but artificial intelligence, we're starting to see a bit of what the impact could be on the bottom line for many companies. A couple of years ago, people were talking about AI, but no one would give any hard data on how that could actually help the bottom line. And 2 years ago, and I've told the story to the team a couple of times, but I wrote a report on the Canadian banks and AI. And when you think about AI, you don't think about the Canadian banks, but I was in my 15-odd year career, I was lucky or fortunate or unfortunate, depending how you look at it, to work across all three business lines of the major banks. So that's capital markets, wealth management, and Canadian banking. So looking back at those experiences and now looking at what AI can do and what it could do in the future, I could see where the cost efficiencies could come from, and even the revenue opportunities. You think about call centers; those are a thing of the past, not just for the banks, but for a lot of companies. Junior programmers, junior IT people. The big one for the banks is credit adjudication. If you can better price risk, you're going to be more profitable as a bank. And then, frankly, the greater ability to understand the needs of customers through technology instead of one-on-one interactions that can take up a lot of time. Except in wealth, of course, we love our one-on-one interactions and we value them with our clients. There's no question, but I know there are ways to improve upon the offerings that banks can give to their clients. And a major bank in Canada just earlier this year at their investor day, they actually put a number on what they could be saving here. So they said that by 2027, they expect to drive about $700 million to $1 billion in enterprise value because of AI. So why this is important to us is now, again, you're seeing actual numbers that analysts can now bake into their valuation models and give credit for AI. So I think this is just the beginning, and we'll see more of that. But it is an important step that I think is helping support the markets. Also, you have to remember, sorry, a real quick last point here is just the positives from the one big beautiful bill that's going to be that is enacted, but will start to really play out in 2026, such as tax cuts, domestic investment spending, deregulation. These are things that should support the economy, as well as obviously interest rate cuts in an environment where we're not in a recession. That's typically very good for equity markets. When interest rates are being cut because the economy is weak, not so great. But if the economy is holding up and we're getting cuts, we think that's definitely a net positive for the markets.
Yeah, and I'll add to that. So productivity gains, that's very important. We don't know, the cadence of those going forward, but we know that company profit margins have been expanding. But the other cushions to the economy really come down to fiscal stimulus and interest rates. So Sunny mentioned interest rates. Think about this. There tends to be upwards of about 12-month lag between when interest rates move and when it starts to really impact the economy, both interest rates going up or coming down. So interest rates have come down quite substantially here in Canada. We're sitting at 2.25% for the Bank of Canada. That is actually starting to encourage investment. It's starting to get companies to borrow because the cost of capital has come down. And on the fiscal side, we don't call it in Canada one big beautiful bill, but Canada just passed a budget which is very investment and forward-looking. And that is going to provide a lot of stimulus, not just into 2026, but hopefully well beyond that. So with a combination of stimulus, productivity gains, I think the risk of recession is fairly low.
Well, on the back of that, not to be a doomsday person, but does a positively humming along economy, does that create any higher chance of inflation?
I can take that one. So let's look at the actual data. I know there are inflationary pressures in the economy. We've seen the price of certain goods go up, but the rate of inflation in Canada is sitting at 2%. And that is the target for the Bank of Canada. I don't really see that changing very much because when you look at that inflation basket, there are some things that are going up, but then there are some large components that are either flat or potentially even going down. We look at the US, where inflation has been sitting at a more elevated level. So their target is 2%. They're sitting at an inflation rate of closer to 3%. But even with tariffs, remember that consumer basket. The consumer basket, that they use to calculate CPI, it's not very heavily weighted towards goods. Goods are probably only a third of that shopping basket. The other 2/3 tend to be services, everything from airfares and hotel rooms. But the single biggest component within services is housing. And housing, month after month, quarter after quarter, is easing. So in absolute terms, U.S. home prices are falling and rents are falling. So that has not yet fully transmitted into those CPI numbers because they use a very smooth process and a lagged process. So on the one hand, you may have goods inflation trending a little higher, but then you have this large services component where there are no inflationary pressures as a whole. So in aggregate, we're actually not too concerned about inflation trending higher. That seems to be what the market's concerned with. We think it's less of an issue, and that's why we think the Federal Reserve in the U.S. could actually continue cutting as we get into 2026.
And as interest rates come down, typically that is beneficial for the housing market. Is that right? If we're looking at, I get those questions a lot. It's so hard to buy a house here in Toronto anyway. Sunny, what are your views on that?
The housing market is something I've been studying for my entire career and all the roles that I've had. So it's always been near and dear to my heart. Lower interest rates are going to help with affordability. Lower sales volumes right now across Canada, particularly in Ontario, is going to help with affordability. But affordability is still stretched. We're not out of the woods. We're still in the early stages of what I would think is probably the start of a recovery. We had home sales across the country, I believe, last month. It was up double digits from the low earlier this year, but that's not saying too much because the low was pretty low. But I do think, yes, interest rates it seems to be that trigger to get people intrigued or not in the housing market. But more importantly, I think in our view is the employment backdrop, right? I mean, if your employment's humming along, then people are more inclined to purchase homes. So it's been weaker of late in the U.S. and in Canada, so that could put a little damper on the housing market. But if we do stabilize a bit and rates do come down, that'll be a net positive. And the last thing I'll say is the wealth effect is very real, right? If markets continue to hum along, that's a good thing. It tends to lead to more spending. But if we get a little bit of a correction in the market, people may tend to hold off a little bit in making those very large purchases. And there isn't a purchase larger than your home typically. So.
Yeah, and I'd say housing is one of those classic sentiment-driven areas in the short term. So when the sentiment it's that balance between fear and greed. When prices are going up, everyone gets greedy and wants to buy, and that positive sentiment results in an overshoot to the upside. That's what we saw during those early pandemic years. Now the sentiment has swung the other way. I agree, affordability isn't exactly where we want it to be, but prices have corrected in various pockets of the market. The sentiment is so negative and perhaps is on the way to shooting towards the downside. It's a cycle like any other. Eventually, supply and demand do find a happy medium. Interest rates are certainly helping, and it might take some time, but we do see that stabilization happening in 2026. There's lots of moving parts. There's things like immigration policy. Maybe if the tariff situation becomes less uncertain here in Canada, that might encourage some people from the sidelines to get in. But it is certainly a buyer's market right now. And it's classic cyclical behavior where right now there's a lot of pessimism. If you are in the market to buy, this is probably as good a time as any compared to previous cycles.
Well, on the cusp of that answer, and thank you for that, I have been reading about a K-shaped recovery. Or K-shaped economy, I should say, not recovery. Sunny, can you explain that to me?
Yeah, there's these terms that you hear it on one news station and it just spreads, and then you hear it on a daily basis. So K-shape is definitely something we hear on a daily basis, and essentially it's the perfect way to describe the consumer in 2025. The top arm of that K, it's the wealthy upper middle class individual, or family. They're doing quite well, right? Inflation is a nuisance, but it doesn't really change their everyday lives. They own assets like stocks and homes, which has generally appreciated post-pandemic, boosting as I mentioned earlier, their confidence to spend. Then there's the bottom arm of the K. That's the lower income households. They're struggling under the weight of debt and inflation. The pullback in discretionary spending here is and will continue to be more severe in our view. For 2026, our strategy does focus on companies that serve, I would say, the upper K of the demographic, as they are the ones that with the disposable income that to keep spending, frankly. And it's unfortunate that divide, but it is happening, and there are ways to position the portfolio to benefit from that.
Okay, speaking of the portfolio, another question or comment that I get from a lot of people is the market too expensive? Are we in a bubble? Are valuations too stretched? Himalaya?
Yeah, the media loves a good story, and there's nothing better than doom and gloom and bubble, and it's easy to draw parallels to whether it's 2008 or back in the early 2000s, or some journalists that are very old, they'll go back to 1987. You know what? That gets eyeballs. As far as the market goes, valuation is at the higher end of the cyclical pattern at the index level. So remember, we were talking about the indexes, an accumulation of all stocks. And the index that I'm referring to right now is the S&P 500. So it is heavily weighted towards technology, and technology companies are growing at a fast pace. Their earnings are growing at not just double-digit rate, some are growing at 20% or 30%. So typically in that situation, investors are willing to pay a higher price for a company that is showing a lot of growth. So you do have the market sitting at all-time highs, but when you look at the underlying earnings, the valuation it's not out of whack from a historical perspective. So that's one thing. The other is, as Sunny was saying, if we look at the 493 companies that are not the Mag 7, the valuation is very reasonable. And I'll just cite you an example. The banks, U.S. banks specifically that I'm talking about, they trade well below the index average when you think about where valuation is sitting. So it's not as easy. There might be some pockets of overvaluation, and maybe the term bubble might be appropriate to those areas. But I think it's a really, really big stretch to say that the entire market is in a bubble. There are plenty of areas of the market that are very reasonable or just downright attractive in our view.
And maybe, Sunny, you could elaborate to our clients who are watching at home, how, given what Himalaya just said, how are we managing our portfolios to avoid the more expensive pockets?
Rebalancing is one way that we do that. We will take positions that have run up in value and exceeded our target weights by a certain percentage, and we'll trim those down, not sell them outright, but because we still believe in the companies, but we'll take a little bit off the table and then rebalance that into lower value companies that we have high conviction in. Outside of that, we've and some of our portfolios, we've moved towards a value ETF that we think is fantastic right now. It holds very high quality names, but it's cheaper on the valuation spectrum. I think what's very important to remember here is that we still want exposure to some of those high value names, and we still do have exposure to some of those high value names, but maybe less so now than we had earlier in the year, now that the stocks and the funds have ran a little bit. And again, going back to our comments earlier with respect to our expectations for breadth or the number of stocks in the index to move higher next year relative to this year, having a good barbell approach of high growth stocks, but as well as high quality value stocks to us makes a lot of sense in growing the portfolios and protecting capital.
Okay, something that we've touched on, and I always think or associate with a higher valuation is as the AI companies. So we've seen the Mag 7, they've performed so well. Is the AI, well, let's talk about how one might invest in the AI space.
Yeah, I'll take that one. So, the early years of any technology, you do want to be investing in, the people that are supplying the picks and shovels. In this case, it's the chip companies and people building data centers and everything that in between. But at some point, and every technology is different, at some point, the best way to invest in AI is actually not companies that are focused on AI, because the applications and the uses of that technology will be widespread. Think about the internet. I love drawing analogies to the late 90s. There was a lot of excitement about fiber optics and the internet and faster and faster servers connecting the whole world. And a lot of those companies, some of them are still around, some of them aren't. I'm not going to take any names. But when you think about what came after, was the rest of the economy was using the internet. And we had a rise in productivity. A lot of businesses that didn't even exist came around after the technology was first enabled. So I think the best way of looking at AI, the way that we're looking at it, is from a future perspective, to focus less on people now building, supplying picks and shovels, and really, who is using it and what are those use cases. And when we come back, Sunny mentioned the financials and the bank applications. That is one area that tends to be very heavy in terms of very high labor force relative to revenue. So if there are efficiency opportunities there, many of those companies, U.S. banks in particular, they are taking advantage of it. They're the early movers, and we've started to see the benefits in their quarterly results. And this is not a 1 quarter or 2 quarter or 4 quarter story. This is something that could continue for years and years and years as far as these efficiency gains. So yeah, we're excited about AI, but looking for it in less obvious places.
I found that fact you said, Sunny, about the one of the banks in their reporting this week saying that they're going to be saving tons of money. Maybe they'll lower fees for us. Okay, well, we've got a couple of questions that have come in from people watching, so I'm going to get to a couple of those. We encourage you to send your questions in if you have any. If we don't get a chance to answer them, then please give us a call anytime. I can hook you up with my two people here. So let's get started. Sunny, this one's coming to you. Okay. I know you've got a political bent to you.
Politically neutral all the time.
So there seems to have been a shift in Canada, particularly this viewer is talking about energy. Can you describe how that has shifted in the last little while and maybe what the implications are going to be for Canada, for our markets?
Yeah, last week I sent out to me, which was a very exciting email. I asked my colleagues if they could see the smile on my face through the email because I was so excited by what I was hearing. Definitely, there's been a significant shift, in my opinion, in policy towards let's say the energy sector. Definitely, high level. Carney made some announcements last week alongside Danielle Smith that, theoretically, it should drive greater stability for the energy sector. It should drive a renewed support for major infrastructure projects. Continued commitment to clean energy is still there, but it should be a more balanced and, I think, pragmatic path to achieving climate goals than that was done in the past. Again, look, it is something that from the top, it's a 180-degree shift in policy stance. For portfolios, this makes Canadian energy and critical minerals much more attractive as the regulatory handcuffs have, I don't want to say they've come off, but maybe they've loosened a little bit, so you have a little bit of wiggle room. But, that said, there's going to be plenty of opposition to Carney's plan. So I'm not holding my breath on anything here, but I am definitely more optimistic on Canada than I've been in over a decade. So that's something that we should all be keeping an eye on and seeing how this plays out over the months and years to come. It is a monumental shift in policy stance, in my opinion.
Okay, thank you for that one. And their questions are coming fast and furious. Himalaya, can you comment on rising unemployment in the U.S.? And I find that this is something that crosses clients' minds when I'm chatting with them. AI. Sunny did such a great job of describing how things might change. Is that also going to contribute to even higher unemployment?
Yeah, so that is a big unknown. I wish I could jump 10 years into the future and see what eventually shakes out. But look, whenever there's a new technology that is as profound as AI is, it is going to cause disruption to the labor force, no doubt. But also, the benefit we have from looking at history is that disruption, while hurting some areas, it results in new jobs in other areas. So let's just stand back and look at the unemployment rate in the U.S. It's sitting, in the low fours. From a historical context, that's still below average. And let's remember that that the U.S. is still creating net new jobs. So we haven't seen that tip towards massive job losses at this point. In Canada, the unemployment rate is sitting higher. And when I look at bank economist forecasts, put those all together and look at it from a consensus view, the unemployment rate is actually expected to dip in Canada. So it was above 7% a few months ago. It dipped below 7%. And the expectation is not for a gangbuster type of economy, but for that unemployment rate to actually creep lower. One part of the entire labor market and unemployment rate statistics that is less appreciated is the denominator, meaning the total size of the workforce. So because of the changes in immigration policy, both here and in the US, that denominator, meaning the size of the labor force, is not increasing at the pace that it has been in the past. So we don't need to create a lot of new jobs in order to keep the unemployment rate fairly stable. And that's kind of what we're seeing right now is even though the number of net new jobs being created is lower, the unemployment rate is actually not changing very much.
Oh, that's so interesting. Thank you, Himalaya. Okay, Sunny, our AI expert. We've had another interesting question come from our audience. Other than the banks, can you give us an example or two of other types of business or industry that'll do well or should benefit strongly from AI?
Everything. Every single industry. Another one that I, in my past life, I used to travel out to Alberta, Saskatchewan, Manitoba quite a lot. So I did a slide on AI and agriculture, which again, you don't put the two and two together, but there's definitely benefits to be had with respect to improving crop yields, detecting parasites and things like that could impact crops, all kinds of functions there, even with respect to the heavy machinery themselves and the use of AI there and the ability to save on human labor. There's a ton of opportunities in that sector, which I think are going to be really interesting and maybe an area that people don't really think about when they think about AI. But I honestly can't think of a sector that will not benefit from this. I forget who I was talking to the other day, but I think he was a firefighter, and he's like, I don't think AI is going to take my job. I'm like, no, I don't think it will take your job, but it could enhance your job, right? With respect to maybe analyzing a fire from a drone ahead and see where the hotspots are and where you can target the flames, things like that. That can make a huge difference between saving a life and not. So I do think AI is going to hit every single industry different ways for different industries, but also a lot of the same ways as well, especially when it comes to, as Himalaya tried to address, is the human side of things and how that impacts jobs and jobs that will be lost, but also jobs that will be created, and new jobs that we've never seen before that will be created from AI.
Yeah, and some of the early applications of AI, I think, a lot of them in the healthcare sector. So, right now, and historically, drugs, new drugs being discovered, it was very much a trial and error process. Let's make this little tweak to a chemical and let's see how it does. So with AI, they're now able to do that trial and error process much faster, and really shortening the time when it could take for a drug to get to market. So that's yet another. I and some other people on the team have had the experience of sitting in a driverless taxi, and that's a perfect example. We've been talking about AI in more of a kind of a software perspective so far. A lot of people think about AI simply in the context of a chatbot like ChatGPT, but the other big application of AI is going to be in the field of robotics. So think about autonomous vehicles. Those are already on the road. They're already doing hundreds of thousands of paid rides per week. So that is yet another source. And again, robotics could help everything from manufacturing to warehousing, to a lot of household uses as well. So Sonia is right. The applications are enormous, and there's plenty of applications that we don't even know about today. That you could have a rise of companies that don't even exist today that could become some of the biggest companies 10 years from now.
Okay, here's a big company. Himalaya, I'm going to direct this question to you because I've heard you describe this story before. Alphabet, which is one of our favorite positions in our portfolio. Can you describe the company and how diverse it is?
Yeah, great question. And this is a little bit of I don't know, I call it a fun fact. It may not even be a fact, but so they changed their name. Remember, they used to be called Google, and then they changed their name to Alphabet. Alphabet, think of it, break it up into two words, alpha and bet. In the investing world, alpha means earning a profit over and above what everybody else is earning, and bet, just like making a bet on a certain investment. So Alphabet is really, think of it as a large R&D warehouse where, yes, they've got the big revenue and profit generator called Google, but they also have lots of other profitable businesses like YouTube, Android, but they have plenty of other R&D projects. I talked about driverless taxis. So they've got a company called Waymo, which is the one that's dominating that field. That's owned by Alphabet. They have healthcare businesses that are within Alphabet. So that's one reason to like it, is that it's much bigger than some of the products that we are all aware of. The other is, when we think about AI and think about any other business, vertical integration makes a big difference. So within the area of AI, there is no company that's more vertically integrated than Alphabet. They do everything from designing their own chips to having their own data centers and cloud. They have their own algorithms. They have their own scientists. They have their own use cases. And they have all of this capability to apply to an existing set of apps. So, next time you're using Google Maps, and it's telling you that there's a Tim Hortons down the road, that's all a result of that. The other thing, when you think about AI and Alphabet, is virtually every scientist that is a specialist in the field of AI, at some point or other, has spent time at Google. And so they are the nexus of a lot of the science that is behind artificial intelligence.
Okay, you can't believe how many questions we have. I think we have time for one more. And Sunny, I know you can talk about this a lot. You're passionate about it. But this will be our last question. I'm sorry we couldn't get to everybody's questions. But as I said, I encourage you to please give us a call. Okay, Sunny, tell us what's happening with Bitcoin and crypto.
I think Gord is better suited to speak to that. Gord and I love talking about cryptocurrency. It's been a very tough year for crypto. There's no question, but I do think there's been a few key developments that have made it arguably quote unquote more acceptable than it was been in the past as an allocation in portfolios. There's been clear institutional adoption. Obviously, major financial institutions like asset managers, banks are increasingly participating in the crypto market. There's now regulated investment products like ETFs in various jurisdictions that has provided a regulated entry point, I guess you could say, for institutional and retail investors. These products allow investors to gain exposure to crypto without actually owning the physical crypto or the complexities that go along with setting up a wallet and managing security and all of that stuff. And then there's been wider accessibility. More traditional brokerages and wealth management firms are offering crypto services, making the asset class very easily accessible for the mainstream investor. Also been a little bit more regulatory clarity, I guess you could say. Globally, it seems like we're moving past the initial uncertainty to establish clearer regulatory frameworks for digital assets. This includes new legislation. This year there was the Clarity Act that was passed in the U.S. that defines how crypto assets are essentially classified. And the last point I'll say is really the scarcity and the digital gold narrative for crypto. For assets like Bitcoin, it's there's a fixed and verifiable scarcity aspect. Only 21 million coins that are out there that has strengthened this narrative for this digital gold. So some view it as an attractive store of value and a potential hedge against fiat currency debasement that you may be reading about in the paper. So a lot of reasons why I think clients or retail investors are becoming more comfortable owning crypto. That said, in our models, we don't have direct crypto exposure at this time. Rather, in some of our models, we'd prefer to get that through a fund called the Fidelity Global Innovators Fund, which we have talked about before, I think, on these calls or on the podcast that we have. And that owns companies that are exposed to cryptocurrency. So you have exposure to names like Coinbase, which you may have heard of, or Robinhood, or Galaxy Digital. These are stocks that the fund owns. And in our view, we'd much rather have a professional manager handling that type of crypto exposure than us trying to pick the best crypto stock or picking a cryptocurrency that's very volatile. So in our view, we do think it's a more prudent way to get exposure for our clients, because again, at the end of the day, it is protecting capital, and crypto can be very volatile.
Thank you, Sunny. So thank you, guys. Thank you, listeners, and Himalaya and Sunny. I want to thank you for your hard work and your prudent stewardship of our portfolios and being available to answer all of my questions and any of our clients' questions. So thank you very much. Gord, do you want to sign off?
Sure. You know what? Great little seminar, guys. I think that it is the end of the year, and very close to the end of the year. Anyways, we've done. I'm amazed. Actually, we've had 3 great years in terms of returns, which has been fantastic. And I think this year, I don't know, everybody doesn't remember all the things that happens, but right at the beginning, I think we just it looked like we were going down the tubes there in terms of I shouldn't say tubes, but it looked like we were actually not going to do very well. Anyways, everybody turned everything, or Himalaya and Sunny turned things around. If you think about the broader market, it's not just about AI. There's a whole bunch of other companies out there where you guys actually talked about, say, the breadth of the market finally started to expand. And I think I saw that in the last couple of months. So thank you very much, Himalaya and Sunny and the rest of the investment team. You guys, I don't want to say you pulled a rabbit out of the hat, but you didn't. You just stuck to your guns and stayed with what you felt was working. And that's how you make money in this game. You just can't jump around, and go to the next shiny object. It has to be well thought out, and I think you guys did that, and you'll continue to do that for for the firm and for all of us great clients that love you guys. We love you guys when we're making money. You know what's going to happen when you're not making money. So, but anyways, good talk. We had a great year. You guys talked about in the face of AI, which I think is going to be amazing. I'm very excited about AI and all the things that happens. And of course, you guys own the best stock, which I think is Alphabet, and all the fun things that they have. So many people I've talked to about driverless cars and are a little worried about jumping into one, but I think it's probably safer than having me out there driving. But anyways, I'm just so fascinated with it. I think it's going to be great, and I can't wait to see more. You talked about the Mag 7 and tariffs, and what the tariffs we're going to do to the economy. I don't think we have figured it out quite yet, but anyways, we'll see. And then the big beautiful bill is going to be another tailwind for us, even though I don't really like the saying of a big beautiful bill, but I think there's going to be a lot of stimulus down there in the States that should help everybody. I was curious on your take on interest rates. You still think interest rates are coming down, which is going to be good for real estate. I mean, that's kind of a funny one. When does real estate bottom, and not so much retail real estate, but when does the industrial real estate and that bottom out, and we start to see some transactions so we can get some liquidity in those markets? I think it's going to be. I think we're close. Every sort of industry goes through a couple of cycles. So now the one thing you did talk about was a K-shaped economy, and I was surprised when you told me what the K-shaped economy was. I thought K-shaped meant Kmart. It was a Kmart economy, and I was trying to figure. So thank you for clearing that up for me. It's not a Kmart economy. It's actually it's a K-shaped economy. Anyways, I understand that now. Last thing, near and dear to my heart was actually crypto. You brought up a little bit talk in terms of crypto, and what I like to say, I quite understand crypto, but it looks like it's I think something's going to happen there, and I think we got to be part of it. Not in a big way, but at least in put our toe in, sort of dabble in. I think you guys are doing the smart thing in terms of trying to get into crypto through our good friend Mark Schmel over at Fidelity, who's done phenomenal. And let him do the bets and pick those, because that's what he's good at. What we're good at is looking after our clients and making sure that we don't make any mistakes and stub our toe on something that we shouldn't have stubbed our toe on. So, anyways, thanks again, you guys. You guys did a great job, and thanks for your guidance and in terms of looking after our money. It's awesome to have you guys as part of the team and part of the Rosedale Family Office. So on behalf of Rosedale Family Office, everybody, happy holidays. I look forward to seeing you in the future, and have a good evening.